episode of Beacon Point 3 and 3, where we bring you 3 financial planning and investing tips in 3 minutes to help you take control of your finances, gain peace of mind, and make better investment decisions. I'm Kobe Kress.
And I'm Robin Gerke. Thanks for joining us today.
You know, it seems that one of the main income planning challenges that we've helped clients through this year is how to access funds in their retirement accounts when retiring before age 59 and a half. In today's episode, we're going to discuss 3 strategies that folks may want to consider if they're retiring early to avoid that 10% early withdrawal penalty they could face on their retirement assets.
I think it's important for viewers to know that we will be covering each of the items discussed today on future episodes, so please check back for future details on these 3 strategies.
All right, Robin, what's our first tip for investors?
Our first tip for investors is to consider utilizing a Roth conversion ladder to access your retirement funds early without a penalty. As many viewers probably know from our previous episodes, a Roth conversion is a tax-saving strategy to transfer funds within your traditional IRA to a Roth IRA. Any amount converted is taxable as income in the year of the conversion. However, any growth in the account is tax-free and distributions are tax-free as well once you've reached 59 and a half. Here is a benefit that comes for those who are under age 59 and a half. 5 years after the original conversion, that original conversion amount can be withdrawn from your Roth IRA without penalty. Let's say you needed $50,000 in the year 2025. You could convert $50,000 in 2020, wait the 5 years, and then withdraw those funds without penalty or taxes, even if you are under age 59 and a half. Kobe, what's tip number 2 for our investors?
Yeah, tip number 2 for investors who are no longer working and are between the ages of 55 and 59 and a half is that you may be able to access funds in your 401k or 403b account while avoiding the 10% early withdrawal penalty by utilizing what is known as IRS Rule 55. Of course, there are stipulations involved, and the biggest one may be that the funds must be in your 401k or 403b account. They cannot be in an IRA account. So if you're leaving your job and you think you may need access to your retirement funds early, be sure to seek advice and have a plan before rolling your savings to an IRA. It may be better to leave them in your 401k plan for now. Robin, what's tip number 3?
Tip number 3 is perhaps the strategy people are most familiar with, Rule 72T. It allows penalty-free withdrawals from IRA accounts and other advantaged retirement accounts before age 59 and a half. We've saved it for last as it's probably the least flexible strategy and therefore should only be utilized, in our opinion, after the other options are considered. 72T requires you to take distributions on a set schedule for at least 5 years or until you've reached 59 and a half, whichever comes later. One of the biggest concerns when applying Rule 72T is that any deviation from that schedule will cause the IRS to assess a penalty on all previous transactions.
There you have it, 3 tips in 3 minutes to help you take control of your finances. Thanks for watching. If you like these videos, please click subscribe, and we'll see you again soon.